All right, welcome back. We stick with the AI trade. Do you, even as the market has gotten increasingly top-heavy? You do. That is the call today from Goldman's head of hedge fund research, Tony Pasquariello. He's here at Post 9. That's your basis of the call. It's like, I know it's so top-heavy, and I know it makes some people uneasy, but you got to stay with it. Is that like a decent way of summing it up?
I think it's fair. There's no doubt the market's top-heavy. There's no doubt it's concentrated. We know this, right? 10 companies comprise 25% of global equity market cap. And it's been narrow, right? So here we are, November. You look back since the start of September, equal weight S&P's dead flat. Semis are up 25 or 30%. I'd say two things about this. Number one is, if all someone does is kind of lament the fact that we have a top-heavy market, you've missed an incredible opportunity set for the past 3 at 15 years.
They are out there. They're out there because we've heard about it. We've heard about it for the better part of that period of time.
That's right. And the second thing I would say is, and we talked about this last time I was on the show, if you go back to the start of 2009, and again, NASDAQ's up 16 of 17 years, and you ask, why did that happen? Only 10% of that is valuation. 90% was earnings growth or dividends. So quite literally, the stocks at the top of the index have earned their place, and I'm just not willing to shoot against the revenue story.
Because the most important point I think you make is the one at the very end of the notes that I have from you to our producers. Does this history book tell us that highly concentrated markets have to end badly, and you say no?
So I think any basic study of breadth, and people throw this term around, it's not obvious to me it's some particularly high-quality lead indicator. You can look at long periods of market history. You can remain concentrated for a long period of time. It happened in the 90s, it happened in the 70s, and the history book doesn't tell you this portends a big sell-off. Sometimes it sets up a momentum reversal, some of the kind of rotations we've seen, but it doesn't tell you the market has to tip over necessarily.
When you have a day like we did, as I was discussing with the panel earlier, where you have like the worst breadth ever for an up day, somebody like you looks at that, and what's your conclusion to that?
Well, it is, again, through the prism of an equal weight index, it's obviously unequivocally bad news. I think the key is you just need to keep your eye on the ball, which is U.S. mega cap tech. Then I would take a step back and I would say, okay, if I want to be negative, if I want to take that as a signal to be negative of the market, I'm going to shoot against 4 big forces. I'm going to shoot against the Fed, so I'm going to violate rule number 1. Okay. I'm going to shoot against an expected cyclical upturn in the economy. We believe that's coming in 2026. I'm going to shoot against all of this CapEx. As we know, that train just picked up more speed last week. And I'm also going to shoot against the flow of funds, which is every day we walk in the office, retail buys the market, and corporates buy the market. So, Scott, you and I have been around a while. It's really hard to pick tops. For my money, again, keep your eye on the ball and stick with the freight train that is U.S. mega cap tech.
You weren't thrown at all by Chair Powell last week?
I think it was a concession to reality, which is he has a very split committee who's operating without a whole heck of a lot of data. Our view is it's still highly likely they cut in December. That makes 75 for this year, 175, including the adjustment cuts of last year.
Let me ask you a question. Why do you think it's highly likely? When he says it's not a foregone conclusion, and went out of his way to follow that up with far from it.
Sure.
Right?
Well, I think he was smart to buy himself 5 or 6 weeks of optionality, because every day is its own ecosystem now. A lot can happen in 6 weeks. But I think the point is this. We're at 3 7/8. I think most people assume neutral is, call it 3%. Everyone's worried about the labor market. So I don't know if it's Powell or the next person. I presume the next person will be on the margin more dovish than he will. But what I'm saying is, this is our forecast. There's a lot of roads that point to them getting to 3%.
What do you make of the lower quality stocks doing well, the higher beta but lower quality? Does that concern you at all?
I think some of it is symptomatic of positioning. I think what we've seen in the ferocious rallies from these stocks is, again, people were short that. The systematic community was short that. When the retail investor sinks their teeth into these, as we saw in 2021, you need to be very careful. It's not a high-quality signal, but again, it kind of flares up every now and again. I don't think it changes the big ball that I laid out originally.